Hello kids, from this video I'm discussing my the paper that I made, the standard paper that made based on 2024 error past paper. And if you want to purchase the other standard papers and other model papers, you can send me a message through my WhatsApp 07656233763 because there are another 5 papers that I made already. But this is very special because this was made based on 2024 error past paper, right? And this contains 6 questions, and from this video, I'm discussing all these 6 questions with workings and other details as well, right? And please do share with your friends. And uh, if you learn even a word, even a equation or something, please do a comment, and that is very helpful and very worthful for me as well. Okay, let's see. So first question is company account, and the first adjustment it says the company has recorded the closing inventory at first. However, the closing inventory was sold on 25/4/2025 for rupees 2850 after spending 415 for packaging and 85,000 for advertising expenses. So this was made. These sales was made after the financial date, but it happened before authorizing your financial statements because it says these financial statements are authorized on 1st of June. So this closing stock sales happen before that, so which means you can adjust the sales for this year's financial statements, but that doesn't mean that you can record that as an sales, right? You have to get the uh, NRV, net realizable value, from that. So how to find out the net realizable value? The estimated sales value, so which means here you know the actual sales value. From that you have to minus the other expenses or sale expenses, all those cases. So NRV is 2850 minus 415 and 85. So you are NRV, net realizable value, of the closing stock is 2,350,000. But the closing stock at the cost that appeared in the trial balance is 2,475. So the difference of that you have to consider as stock written off, and that stock written off expense you should record in other expenses. And here stock you have to measure at the lower value comparing NRV and the cost value. So here your NRV is 2,350, and in SOFP you have to mention inventories as 2,350. But from this adjustment, it's nothing changed to the cost of sales because you have to find out cost of sales based on the cost of the inventory, not for the NRV value. Whether the NRV is higher or lower, that doesn't matter. Always, when you're finding out the cost of sales, you have to measure your inventory, your closing stock at cost, right? So nothing changes for cost of sales. And the second adjustment, the balance of trade debtors shown in the trial balance after deducting bad debts, 240,000, identified on 31st March 2025. And this bad debts has been recorded under other expenses. So normally you put bad debts under distribution expenses, but in this case, they are recorded bad debts under other expenses. But the case is, after the reporting period, as mean after the 31st March 2025, on 15 May 2025, the previously written off bad debts was recovered in cash. So you have to reverse the bad debts entry here. But you can't recover the bad debt recovery as in other income, right? Because this happens after the reporting period, but before authorizing the financial statements, so which means you can adjust that. It is an adjusting event as per LKS 8 or 10. Those events after the reporting period standard. Right? So in this case, you have to reverse the bad debt entry. So which means from the other expenses, you should minus bad debts, and to debtors, you should add that. So in trial balance, the debtors appeared as 6,260. To that, you have to add the bad debts reverse entry, 240, And that is a trade receivable that you should mention in SOFP under current assets. That one, it says the cash balance shown in the trial balance is the balance as per 31st March 2025. But on this date, out of this balance, 800,000 has been invested in a fixed deposit. So that fixed deposit you have to mention in SOFP under non-current assets after property, plant and equipment and right of use of lease property. And then another 600 they invested for 3 months treasury bills, and then you can find out the remaining cash in hand. So the remaining cash in hand and 3 months treasury bills you have to mention in a separate note as cash and cash equivalents, right? So that's it for first, second, and third adjustments, and then let's discuss 4, 5, and eight adjustments later. That adjustment, it says the warranty provision estimated for the financial year. This financial year is 790, and the warranty expenses paid includes 610 relating to the sales for the previous year. The balance payment relates to the sale of the current financial year. So in here, the sales warranty provision in the trial balance, it says the provision for sales warranty for the last year is 445. But you paid 610 for the last year in this year. So which means in the last year you did an under provision. But you can't go back to the last year and correct that. So the under provision that you made for the last year, you have to add for this year's sales warranties. And which means the warranties that you should mention under distribution expenses, it should be 955. After adding the under provision that comes from the last year, right? And uh, for this year, sales warranty is 790, and the sales warranties payment appeared in the trial balance is 850. So this 850 includes 610 that paid for the last year. So which means you paid 240 for this year. And when you identify the sales warranty provision at the end of this year's in SOFP current liabilities, you have to minus the payment that you made for this year's from this year's total provision. So this year's total provision is 790, and you already paid for this year's 240, and which means the sales only provision that you should mention in current liabilities is 550. Same for the income tax as well. The total tax estimate for the financial year, this financial year is 2040. And as per trial balance, the tax that you made for the last year is 1020, the provision. But the actual amount that you paid for the last year is 810. So which means in the last year you did an over provision for the taxes. But you can't correct the last year's financial statement. So the tax over provision that you made in last year, you have to correct for this year. So from the total provision, you should minus the over provision, and the taxes that you should identify in your income statement is 1,830. But still, the total provision for this year is 2,040, and the income tax paid that appeared in the trial balance is 1,240, and this includes tax payment for the last year 810. So which means you paid 430 for this year's first 3 quarters. So the total provision is 2040, and you paid already 430 for this year. So the remaining amount 1610 is the amount that you should mention in current liabilities as tax provision. Okay. And here, the fifth adjustment is given as per SLFRS 15, identifying the revenue. So here, Anuradha company, so which means this company entered into an agreement with Barrister company to sell 20 units of machines at 120,000 each, and to provide maintenance services to the 1 year at 12,000 per machine per year. The total consideration, so which means the total income, total revenue it's received, and you already recorded that as in sales. But as per as on 31st March 2025, you sold only 10 machines and have been installed, and maintenance services for 3 months have been provided for each of those machines. So from that adjustment, you have to identify the unearned revenue, and that unearned revenue you should minus from sales, and then you have to identify that as a current liabilities. So here, the total equipment sales revenue is 2,400, and after sales income is 240. So the total revenue is 2,640. So this already received and recorded as in sales, but the realized income is you only sold 10 units, and you provide uh, 3 months service for each unit, so which means 30. So from the total revenue, you should minus the realized income, then you can find out the unearned revenue, and these unearned revenue you have to minus from sales, and then you have to recognize in current liabilities as unearned revenue. And the sixth adjustment is given about property, plant, and equipment. And here the items are land, building, motor vehicles, and office equipment. And here the cost of revaluation value and the accumulated depreciation is given as in closing date. And here it says all these property, plant, and equipment are used for admin purposes. Depreciation for the financial year has been correctly calculated and recorded under admin expenses. Furthermore, no purchases or disposals of PPE have been made during the year. And here, the first thing, land is accounted for under the revaluation model, right? On 31st March 2025, the land was revalued, and the revaluation gain of 350,000 was recorded. And this revaluation is recorded correctly. So, which means the given information, land as per the closing date is 1,850, and this 1,850 is after you recorded the revaluation, right? So land opening balance should be 1,500. But the case is this has been correctly reflected in the land account and credited to the revaluation surpluses of the land. However, it was later identified that there was a revaluation loss of 150 from the previous year. This year, from this year's revaluation surplus, you should written off the last year's revaluation deficit. But instead of that, what they did, the total revaluation surplus they recorded in revaluation surpluses or revaluation reserves account, right? So in the trial balance, the land revaluation reserves, it is 900. So this 900 is after adding that 350. So you have to exclude that 350 from 900. Then you have to identify the opening balance of revaluation reserves as in changes in equity statement 550. And that written off, the deficit written off, you should mention in other expenses as land revaluation deficit written off. From that, you have to minus 150 from there. So the total surplus is 350. And from that 350, you written off 150. So the remaining 200, you have to mention as in other comprehensive income, land revaluation surpluses. Okay. And a second adjustment is given about the building, and building was revalued for the first time on 31st March 2025, resulting in a revaluation loss of 800,000. So your revaluation loss is 800,000, and the accumulated depreciation transferred at the revaluation is 800, right? So the revaluation at the revaluation date, you have to transfer the accumulated depreciation up to that date. So up to that date, buildings accumulated depreciation is 800, and that was transferred when you are doing the revaluation, right? So here, the revalued amount is given as 2,400 for the building. So 2,400 should be your closing balance. And after adjusting this depreciation of for revaluation and the revaluation loss or deficit, then you can find out the building's opening balance as 4,000. And building's opening balance 4,000, and the useful life is 20 years. So which means it already depreciated for this current year 200. And from 800 you have to minus 200, then you can find out the opening buildings accumulated depreciation, right? The depreciation is recorded correctly, so nothing to do over there. They already recorded this revaluation deficit in other expenses, right? And for the motor vehicles and equipment, there is no any adjustment, so which means there is nothing, no any disposals of purchases. So opening balances and closing balances are equal. And here the accumulated depreciation is given after adding this year's depreciation. So you have to exclude the this year's depreciation, and then you can find out the opening accumulated depreciation. And from slide, I am discussing the ninth adjustment, the last adjustment as well. The share capital disclosed as in 1st of April 2024. Oh yes, for the stated capital, it consists the ordinary shares issued at 25 for each. So the ordinary shares as in the trial balance, the value is 8 million, and 8 million divided by 25, you already issued 320,000 shares, right? On that date, here the research capitalization happens, so which means you issued shares using your retained earnings at the ratio of 1 for every 8 shares. So on that date, there were 320,000 worth of shares, and that 320,000 you have to divide by 8. Then there are 40 shares, 40,000, and that 40,000 you have to multiply by 20. So which means your share issue is 800,000. And that resource capitalization, or we can term that as bonus share issue as well. So that resource capitalization you should minus from the retained earnings, and then you have to add it to the stated capital. And that you should present in statement of changes in equity. Seventh adjustment is given about the lease property. On 1st of April 2024, the business obtained a computer system from single company under a 5-year financial lease. An initial payment of 850,000 and installation cost 150,000 were incurred and recorded under admin expenses. So that's totally incorrect. So you have to exclude those from admin expenses, and then you should added those two under right of use of lease property when you are finding the cost of the lease property, right? And the lease installment is given over there, 750,000 per year, and the discount factor is given. So after multiplying those discount factor, you can find out the present value, and the total of present value you should add it to the uh, cost of the lease property. Then you can find out the final cost, and here it should mention the useful life is 10 years, and this belongs to the company after the lease. Huh? I didn't given that in the adjustment. So then you have to do the depreciation for the useful life, and this depreciation is not recorded. So that you should add it to the admin expenses, and then the carried amount. And carried amount you should mention under non-current existing assets. So that's a uh, one part, and the other part you have to mention that you have to do the adjustment for the lease creditor. So the lease creditor opening balance is 2,625, which means the present value of totals, and the interest based on that 10%, and that interest you should mention in finance expenses, and this interest is not paid up to the yet on 31st March 2025. So which means this interest payable you should mention in other payables, right? And the installment after deducting the balance as in closing date is 2137.5, and this you should split between current and non-current. And from the current position, you have to minus the interest that you are going to pay in next year, and that you should measure based on your closing balance 10%. And the non-current liabilities after excluding that current position from the closing balance. And in this case, the installment is not yet paid as in 31st March. So this year's lease portion is also you should add it to the your current position of lease creditor. So this year's total installment 750, from that this year's interest payable and 487.5 plus The lease portion that you're going to pay in next year, 536.25, those two should add up together and then recording current liabilities, right? And this value you should mention in non-current liabilities. Yes, that's how to discuss company account, and this company is I prepared based on 2024 error past paper. Let's see the other questions. Second A, a bit interesting because it's given about the pay sheets. Aban's cleaning company employed 25 workers in September, and they worked 4,250 hours for mm, yes, for September. And in October, there were 40 employees and they worked 6,700 hours. Each employee is required to work 150 hours per month, and any hours worked beyond that are considered under for overtime hours. The normal hourly rate is 400 and the overtime hourly rate is 600. And from the employee's gross salary, 800 is deducted for EPF and 2% is deducted for welfare. And the net salary for the current month is paid to the employees on the 10th of the following month. So this year's salaries you are paying in next this month. Sorry. This month's salaries you are paying in next month, right? So we need all 2 months here to prepare the salaries payable account. In salaries payable account, there should be a credit side balance. What is that? The September's net salary payables, right? So which means you have to find out the September's net salary first. So normal hours, there were 25 workers for September into 150. It's 3,750 into 400. And the total hours they work is 4,250. From that 3,750 minus the overtime hours is 500, and that you should multiply by 600. And then you can find out the gross salary. From that you have to deduct the EPF 8% and welfare 2%. Then you can find out the net salary. And this is the opening balance of the salaries payables. And that you should debit as cash because you are paying that, which means the September's net salary you are paying in October. So that transaction you should present in your salaries payables account. And then for the October, there were 40 members into 156,000 hours, and the overtime hours are 700, and then the gross salary, EPF and welfare and the net salary. And these cases you should mention in salaries and wages control account. The total salaries and wages, the gross salary, you should debit to the salaries and wages expense and then credit to the salaries and wages control account. And from that to EPF, you should written off 225,600. The double end should be salaries and wages control account debit, EPF credit, EPF payables credit, and then the welfare fund contribution, salaries and wages control account debit, and the welfare fund credit. And then the remaining balance. So this is what is this? This is the net salary of yours. So this net salary you can't just keep in salaries and wages control account because salaries and wages control account is not a liability account. It's just a nominal account. So the balance of that, the net salary payable, you should transfer from salaries and wages control account to the salaries payable account. And that is the closing balance of the salaries payables, right? Okay. And now we have production overheads. So in this case, these are factory contains fabrication, assembly, stores, and maintenance, 4 departments. Out of that, fabrication and assembly are production departments, and stores and maintenance are service departments. So they already found out the overhead absorption rate for fabrication and assembly based on machine hours and labor hours. But there are some omissions and errors that they made from the accounting clerks, assistant accounting clerk. Okay, so you have to correct those things. Then the first thing that you should make is just a production overhead analysis sheet. So first of all, you can find out the fabrication and assembly opening balances, which means the drafted overheads by multiplying the given absorption rates into their machine hours and labor hours. And it says these production overheads are calculated excluding stores drafted overheads 360,000. So that you can identify here as for the stores as well. And what they did, the maintenance department overhead, the drafted overhead, they divided for fabrication and assembly equally. So you have to exclude from fabrication and assembly 140,000, and then identifying the drafted maintenance overheads for maintenance department. And then they ins they appropriate insurance equally for all departments. So you have to exclude those insurance, and then you have to appropriate insurance based on floor space, right? And they o- uh, they distributed electricity as per floor space. That's incorrect because in the other information there is given electricity unit. So you have to always use the most appropriate base to distribute, right? So you have to exclude electricity based on floor space, and again you have to distribute electricity based on electricity units, right? And then the welfare, same thing, welfare, they distributed based on labor hours, that's incorrect. So you have to exclude that. And again, you have to distribute based on number of indirect employees. And the motor vehicle depreciation, sorry, machine depreciation, they directly allocated for fabrication only. So that's also incorrect. You have to exclude that. And then again, you have to distribute based on cost of the machines for each department. And then you can get the totals. And then the maintenance department overhead, you have to distribute based for fabrication, assembly, and stores based on maintenance hours. And then the total of stores after adding the maintenance overhead 400,000 you have to distribute for fabrication and assembly as per store's requisition notes. Then you can find out the adjusted overheads for fabrication and assembly. Then you can divide those from machine hours and labor hours to find out the adjusted production overhead absorption rates. So I here valued at the closest uh, value as 126 and 100. Now it's easy. The large and small prime cost is given, and when you are absorbing, you have to multiply by the given machine hours for fabrication department and given labor hours for assembly department. Then you can find out the absorption overheads from fabrication and assembly department for large plastic chair, and two small plastic chair. So after adding the prime cost and the production overhead, then you can find out the production cost per unit, right? So that is easy. Do a comment, huh? Okay. So, question number two, see, I given about the ratios here. Following is the information of Rupa Singh company, and I given the very short and sweet income statement and then the additional information. So this is very easy type of question for the ratios. And here they are asking the net profit ratio. So net profit ratio means the net profit percentage based on sales, right? So your net profit is 4,000, sales are 12,500. Then you can find out the net profit ratio. And the interest coverage ratio mean how many times that you can pay the interest from your profit. To find out that profit plus interest plus tax divided by interest. So in this case, you can pay 20 times of interest from your profit. Debtors turnovers to find out the credit sales divided by average debtors. So in the other information, it says 80% of the sales are made on credit. So which means your credit sales is 10 million and the average debtors is given directly. Then you can find out the debtors turnover. And inventory obtaining period to find out that Cost of sales divided by, sorry, average inventories divided by cost of sales into 360 days. So which means you can find out that as 90 days. And yes, that's it. Here the inventory holding period. Before that, you can find out the inventory turnover by dividing cost of sales from the average inventories. And then you can find out the inventory obtaining period by dividing 360 days from the inventory turnover. Right? Yes. Question number 3A is given about the equation, and I like this equation, right? This was freshly prepared, freshly made uh, using the 2024 past paper, right? So here, Nuwan Traders is a business that imports and sells modern electricity fans in Sri Lanka, and this business is registered for value-added tax. As at 1st of October 2025, the following balances were extracted from the business's ledger accounts, and the opening balances are given for PPE, inventory, debtors, cash, equity, trade creditors, and then the VAT. Right? And there are 10 transactions. So what you should do, you have to record those 10 transactions in the given accounting equation. Right? But first of all, before that, you have to mention the opening balances for assets, liabilities, and equity. And the first adjustment is the business purchased a computer system for its own use for 134,400, including 12% VAT. So if it is a VAT registered business, you have to exclude the VAT and identify the property, plant, and equipment value. So here, the the computer system after excluding that VAT is 120, and but you paid with VAT amount 134.4, it should minus from the cash, and the purchases that you paid at the purchases you should decrease, or you should deduct from VAT payables, right? Second one, the owner paid the opening balance of the trade creditors after receiving a 5% discount. So trade payables, the opening balance is 170. It should deduct from trade payables. And when you're paying that, the owner paying that, you are the owner receiving mean the company, the business is receiving 5% discount, and that you should mention as in income, and which mean the amount that paid by the owner is 161.5, and that is an additional capital. It should add it to the equity, right? Third one, the opening inventory consisted of 20 units. Of these, 15 units were sold at a cost plus 25% for cash, with 15% VAT applicable on the sales. The remaining 5 electricity fans were kept for businesses' use, right? So here the opening inventory, the total cost is 320,000, and this contains 20 units. So 320 divided by 20 units is 16,000, right? So one unit is equal 16,000, and here you are selling 15 units. So 16 into 15, the cost of sales is here 240,000, and based on that you have to generate the profit. So 240 into 60%, your profit is 60. So 240 plus 60, the sales before VAT is 300, and to that you have to add 15% VAT, so it is 45. So the sales VAT, which mean you are collecting that VAT, and that VAT you should pay to the government. Until that, it should add it to the VAT payable account. So the cash receiving here, the with VAT, sales with VAT is 345. And the remaining 5 electricity fans, they kept for the business use, so that you have to transfer from inventories to the property, plant, and equipment, right? Fourth one, the total operating expenses. Didn't I given the fourth one? Ah, yes. Fourth one, during the month, 25 electricity fans were purchased at 20,000 each. So 25 into 20, the inventory value is 500. And at the purchasers, you paid cash for 5 units. So which means you paid 100 before VAT. So adding that 15% VAT, VAT with purchases you paid is 115, and the other 20 electricity fans you purchase here on credit. So 15 into 20, sorry, 25 into, sorry, 20 into 20, the purchases before VAT is 400, and to that you have to add 15% VAT, so it is 460. So your trade payable should increase by 460. And VAT include that cash purchases is 15, and the VAT include that credit purchases is 60. So altogether, the VAT that you paid for payable, so that you goes out from the business is 75 at the purchases, and that should minus from the VAT payables, right? Fifth one, total operating expenses for the month is 140. So equity should decrease by 140. And from that, 25 was paid by the owner's personal money. So equity should increase again from the additional capital. So which means the businesses funds used only 115, and that should minus from cash. Sixth one, from the opening trade debtors, 10,000 is bad. You should minus that from the trade receivables and as in equity because it is an expense. And the remaining amount you received here, so trade receivables minus 200, and at that received point, you gave them 5% discount. So 200 into 5% discount, discount allowed is 10,000, that and that is an expense. So after allowing that 10,000 discount, you received only 190. And seventh one, from the stock purchase during the month, 10 electricity fans were sold on credit at cost plus 25% percent profit. So which means the cost of sales is 200, and you are selling that adding 25% cost, 25% profit on that cost. So your profit is 50. So 200 plus 50, your sales without VAT is 250. And to that, you have to add 15% VAT. So your sales VAT is 37.5. So in here, debtors, you should increase sales with VAT value, 287.5. And from those inventories, two electricity fans were withdrawn from the owner. So that should minus from inventory as in equity as well, because that is a drawing. So at the end of the day, the total inventory was estimated at the net reserve value is 18,000 per unit. So here, within that month, you purchased 25 electricity units, and from the 25 electricity units, you sold 15 units. Yes. Yes. Sorry. You sold 10 electricity units, and owner withdrew 2 units. Sorry, again. In that year, in that month, you purchased 25 electricity fans, and from that 10 electricity fans you sold, and 2 electricity fans withdrawn by the owner, and the remaining electricity fans are 13 units. And those products, sorry, cost is 20,000, but the net reserve value is 18,000. So which means 2,000 per unit, you should do the written off, the stock written off. So altogether, your written off is 26, and that should minus from inventory and equity as well. And the last adjustment transaction, 10% of the VAT payable balance at the end of the month was paid to the government in cash. So at that point, you have to find out the VAT payable amount. From that, 50% is paying here, VAT minus and the cash minus. So that's how you have to record 1 to 10 transaction in that given accounting equation. And the question 3b. Question 3b is given about the non-profit organization, but here I only considered about the subscription income. And there is given 3 points, three information, and from those 3 information, you have to find out the required cases. And here, as in opening date, there were 40 members. And as on 1st of July and 1st of October, they recruited 25 and 35 new members. And the interesting thing here is the financial reporting period that you should consider here is your normal calendar year, which means from 1st of Jan 2024 to 31st December 2024, right? So in this case, first you have to find out the net membership fee income. So as in opening day, there were 40 members. So 14 to 2,400, total 96,000. And on July 1st, you recruited 25 new members. So from those, you have to find out subscription income only for last 6 months, right? So if it is 2,400 for the annual subscription, a monthly subscription is 200. So that's how I got here 25 into 200 into 6. And then on first of October, you recruited another 35 members. And from to those, you have to find out only for last 3 months in income. So it is 21,000. So your gross subs income is 147,000. But from that, you have to return off the subscriptions. There is 10 members as in opening day receivable for the last 6 months. And out of those, 5 members didn't pay for subs in this year as well. So for those 5 members, you have to exclude, which means you have to written off the subs for the arrears amount as in opening day. So which means the last 6 months for the last year plus this year's for subscription. So which means altogether there are 18 months, right? So after written off in that subscription, your net subs income that you should identify is 129,000. And in the second, they ask in the cash received for membership fee. Uh, After you written off in those 5 members, now the opening members should be 35. So 35 into 2,400. And the new members that you recruited middle of the year, they paid the total 2,400 at the admission, right? And from those, then again you have to exclude the, and then to that you have to add the opening receivable from those 5 members. 5 out of 10 they are paying correctly. So those 5 opening receivables, and from those you have to exclude the closing receivable at the end. Then you can find out the subscription received in cash. Right. So subscription receivable at the end, it's only 8 members for whole year 2,400. And the subscription received in advance, the members that you are recruiting at the middle of the year, they are paying for the full year at the submission. Right. So the members that you recruited on July 1st, they paid for 6 months extra. And the members that you recruited on 1st of October, they paid 9 months extra. So altogether, the subs received in advance here is 93,000. And all these cases, you can find out some subscription income as well. So the hardest thing is to find out the subscription received in cash. And to that, you can find out, you can record the subscription income, receivables, and received in advance as in closing date in subscription account, and then balance that, and then you can find out the cash receipts. Either way, it's okay. But they don't ask the subscription income, right? Subscription income account. They are only asking these cases. But to find out the subscription received in cash, you can follow up the subscription income account as it's given here. Okay. Question number 36 is also another interesting case. As per opening date, the current account, uh, cash account balance and the bank statement balance is equal to each other, but at the end of the March, it's not equal to each other. So the summarized cash account is given and the additional information is given. They're asking the bank statement, which means the summary of the bank statement that's sent by the bank to the business and the adjusted cash account and reconciliation statement. As like in these questions, you have to draft the all things that they're asking, which means the adjusted cash account, bank statement, and the reconciliation statement. So the adjusted cash account, the opening balance should be the cash account closing balance, 246,000. But in the bank statement, the opening balance should be the opening balance of the cash account, 112,000. And here the bank reconciliation statement, you are finding out the bank statement balance based on the adjusted cash account balance, right? So which means you have to add the unpresented checks and minus the unrealized checks. And here in the first adjustment, it says of the total check deposited. In cash account, the total check deposited is 278. From that, 18,000 were dishonored. So when you're depositing check, you are debiting that to the cash account. And when those dishonored, you should credit that to the cash account. And then realizing the bank statement is 190,000, then you can find out the unrealized checks. So the total checks that deposited is 278. From that, realized in the bank 190 and dishonored 18. So which means the unrealized, deposited but unrealized checks are 70,000. And for the check issued, you issued totally 264,000. From that, 24,000 worth of checks dishonored. So when you're issuing checks, you are crediting that to the cash account, and then when those dishonored, you should debit back to the cash account. And check issued and presented is 170,000. Then you can find out the unpresented checks. So you issued already 264. Presented for payment in this month 170 and dishonored 24. So after excluding those two from 264, you can find out issued but unpresented checks, right? And the direct deposits you should debit to the adjusted cash account, and the standing orders you should credit, and the bank charges you should credit, and those things you should mention in bank statement as well. And here the hidden information is cash deposits. So in the given cash account, it says the cash deposits are 120,000. So that you should mention in bank statement as well as cash deposits, right? So that's how you have to do this question. So let's move for question number 4. Question number 4A, it's a big question that I given about the payment reports. And in this case, you have to prepare cash receipt journal, cash payment journal, sales journal, purchase journal, and general journal, and after all, VAT control account, right? And here, first of all, you have to draft all the time entry books that they're asking. Senior publication. Senior publication is the my business. Commenced business operations on 1st of October. This business prints and sells practice question papers as like I'm doing here for GCE advanced level subjects, and it is registered for VAT with a 10% VAT applicable for both purchases and sales, and VAT should be applied after deducting trade discounts on purchases and sales. The summary of transaction for the month ended is 31st October 2025 is given below. So these transactions you should record in the given prime entry books. So which means the prime entry books that they ask you. First adjustment, first transaction, owner's capital contributions and cash withdrawals. So here the owner contributed 240,000 in cash. So that thing you can record in cash receipt journal as capital, and that you should analyze under other receipts. And the printing machine investment you should mention in general journal, printing machine debit and capital account credit. And to that you have to find out the depreciation. So be careful over there. It is given the printing machine has a useful life of 10 years, but the given reporting period is only for October, a month. Then you have to first find out the annual depreciation and then again that divided by 12. So machine depreciation debit, machine accumulated depreciation credit, right? And then the owner makes monthly cash withdrawals 12,000 and that you should mention in cash payment journal and analyze under other payments. And here the stationery purchases. So you purchased 100 A4 reams from Atlas Limited at 2,250 per ream. Payment for 40 reams was made in cash and the remaining on credit. So here, under cash purchases, you receive 10% discount, and the credit purchases, you received 5% discount, right? So these are the trade discounts. So you are not recording trade discounts as debit and credit, but you should deduct the trade discounts, right? So the cash purchases 40 into 1,250 is the gross purchase amount 50,000, and to that you have to exclude the trade discount 10%, and which means 45,000. And from that 45,000, you have to find out what the VAT, right? So here in the cash payment journal, the purchases without VAT 45, and to that 10% VAT 4.5. Altogether, the amount should be 49.5. And the credit purchases here, you are purchasing the other 60 on credit. So 1,000 to 15 to 60, the gross amount is 75,000. After 5% discount, the purchases without VAT is 71,250, and to that VAT 7,125. So altogether total 78,375, right? And you purchase 20 input from Canon all on credit. So 20 into 4,000 credit purchases is 80,000 gross amount. And from that you have to exclude the trade discount. And after excluding trade discount, the purchases 20 into 4,000, 80,000 into 96%. Yes, 76.8. So which means the purchases without VAT is 76,800. To that 7,680 VAT, and the total is 84,480. Then you can find out the totals of the purchases. And then we are coming for the payments to the creditors, and here it says paid Atlas Limited 48,000 after 4% trade discount. So here, no, in the paper it says trade discounts. It should corrected as cash discounts. Trade discounts are better and cash discounts. So 4% cash discount, and that 48 is after receiving 4% discount. So the cash amount that you paid is 48, and that is the same amount that you should mention in creditors. And then you have to find out the cash discount. So that is 2. How to find out that 48 divided by 96 into 4. And here 60,000 balances to Canon Limited after 5% cash discount. So this 60,000 balance, when you're paying the 60,000 balance, you received here 5% cash discount. So this is before excluding that cash discount. So your amount should be 57 and the discount should be 3, and that 57 you should mention in creditor payment as well. And payments to teachers for authorship, which mean the loyalties. And there were 10 LL subjects and 10 teachers, 25,000 per each. So the total should be 250,000, but only paid 75%. So 187.5 should comes in cash payment journal, and that should mention as in expenses as well. And the remaining amount, the payable amount, you should mention in general journal as loyalty payments, authorship payments, debit and payables credit, right? And the operating expenses payments in October, total operating expense were 24,000, but at the end, 6,000 was payable, and that 6,000 payable you should mention in general journal. And 24 minus 6, you paid only 18,000, and that is the amount that you should mention in cash payment journal. And here sales, we are coming to the sales. And here it says you are selling 300 sets to Sarasavi to at 2,000 per set. And here you are selling 100 sets for cash. Same thing in cash says you given 10% discount and credit says you given 5% discount. So for Sarasavi cash sales, 100 sets into 2,000. The gross amount is 200,000. From that, you have to exclude the trade discount 10%. So 180,000, right? So your cash sales before VAT is 180,000, and to that 18% VAT you should add it, and the total amount is 198. And the credit sales, 2,000 into 200, 400,000 your gross amount. From that you have to exclude the VAT 5%. So the VAT before VAT, the credit sales is 380. To that, you should add 10% VAT, and your total should be 418. And for Godage, you are selling all on credit. So 200 into 2,400, the gross amount is 480,000. And from that, 10% after excluding 10% discount, your sale should be 432. Into that, VAT 10%, and then you can get the total, right? And then here, receipt from debtors, and here it should be correct as cash discount. So you are giving discount for your debtors, so those should term as cash discounts. So receive 226, so that you should mention under amount and discount here. And then received 114, and the discount at that point you have to find out 114 divided by 95 into 5, then you can find out the discount here, right? So that's how you should prepare cash receipt, payment, sales, purchases, and general journal. And then you have to prepare the VAT control account. First of all, VAT credited from cash receipt journal, the VAT collected from cash sales, and then again you should credit to VAT control account from the credit sales, VAT collected from credit sales, and then you have to exclude the VAT paid at the cash purchases and VAT paid at the credit purchases. Then you can find out the VAT control account closing balance. So that's how you should prepare the all these prime entry books. So the B part of question number 4 is there is another interesting question I given about the investment decision. And the interest part is here it includes the 10% based on uh, profit before tax, right? So this Kruti, I mean, there is so the syllabus was changed in 2017, and the 2019 are the first ones that who faced for the new syllabus. So up to from 2009 to this date, this profit adjustment is, sorry, tax on profit adjustment is not given for the investment decisions, but that included in your purchase guide, the teacher's guide that republished in 2017, right? So here the company is considering a project to purchase a machine costing 4 million. So there is nothing given about the carriage inverse and installation, nothing. The useful life is 400,000 and the useful life is 4 years. The expected annual production from the machine is 2,000 units annually. And the first year selling price is 1,250, and that 1,250 multiplying by, it increased by 250 in each year. So this year selling price is 1,250, but for next year's 1,500, 1,750, and 2,000, and those you should multiply by the annual production, then you can find out the sales revenue. And here it's given the contribution to sales ratio. So contribution to sales ratio means the percentage of contribution based on sales. So the other part is about variable cost. So variable cost based on sales is here 40%. So from the sales revenue, you should find out 40% as your variable cost, and that is an expense. And here, the including depreciation, the fixed cost in the first year 1,200, and again that increased by 100. And here you should consider depreciation as well, because at the first place you are finding out the profit before tax to find out the tax, right? And then you can find a profit before tax, and from that you have to exclude the income tax. Then you are getting the profit after tax, and the difference between profit after tax and the cash flow. So, which means if you convert profit after tax to the cash flow, you have to add the depreciation, because depreciation is an expense. So that's why you consider that when you are finding out the profit before tax. But depreciation is a non-cash transaction. So when you are finding the cash flow, you should add back the depreciation, right? Then you can find out the operating cash flow. And then after adding the disposals at the end, then you can find out the net cash flow. And now you know the net cash flow, you should multiply by the given discount factor. Then you can find out the net present value. The total of present values of future cash flows, you should deduct it. From that, you should deduct the initial investment. So in this case, you got the NPV plus value. So which means this investment is okay to be proceed, right? Okay. I'm a bit tired actually. There is a lot to discuss in this question paper. But hold on for 30 minutes. So from 30 minutes, yes, let's see. Question 5 is given, the main question is given about the partnership. And in question 6, the main question is given about the, let's see. So this partnership is given with new partner admission at the opening date, and the existing partner retired at the closing date, plus with some incomplete record. So let's see. So they ask in income statement and appropriation account, current account and capital account. And as in opening date, there was Harat and Virendra, and they recruited Nimal as the new partner. And at the end, Sarat was decided to retire from the partnership, right? So first of all, actually, you have to do the capital account. So which means you should record the new member recruitment at first. So I will discuss that in the next slide. Okay. So I'm starting from this slide, which means from the yeah. Sarat and Virendra are the partners in partnership trading business, each contributing 4 million and sharing profit and losses equally. As on closing day, Sarat and Virendra's total capital balances were given as 4,450 and 3,750. Darling, from that you have to find out the current account balance, right? So the total capital is represented by the current and capital account total balances. Actually, it should term as total equity. So total equity is represented by the total, capital balances, total of the capital balances and the current balances. So they uh, invested 4 million equally, but the total capital there is a difference. So that difference is that is your current account opening balances. So Sarat has a favorable balance 400 and Virendra has a unfavorable balance, not 400, sorry. Both have the 250 balance, but Sarat has a favorable balance. So which means in his current account, that's a favorable balance in credit side. But for the Virendras, it's unfavorable balance, so which means at the opening date, it should credit it. Sorry, it should mention as in debit side, right? And yes, and the Nimal recruitment. So I will discuss in the next slide. During the year 2024-25, 70% of sales were on credit, and the remainder was cash sales. from the year's credit sales, 2,260 was collected. And to find out the credit sales, you have to go to the debtors control account, and there is a debtors balance increasement. So the closing balance should be 400, and the cash collected is 2,260 after allowing discount allowed. And darling, that discount allowed is an expense for you, so that you should mention under expenses. Then from that you can find out the credit sales, and this 2,800 is equal to 70%, so which means your total sales is 4,000. And here the old purchases were done on credit, so you have to find out purchases through credit control account. And here, after allowing 80,000 discount, so that 80,000 discount received is an income, right? And discount received in cash, you should debit to the creditors control account. And here, the interesting thing is, Sarath is personally paid 180,000 for the creditors. So that amount you should credit to the Sarath's current account and debit to the creditors control account. Then you can find out the balance, sorry, purchases. But before that, there is a balance decrease. So there is no any opening balance, sorry, closing balance, but the opening balance is 250. Then you can find out the purchases here, right? And at the beginning of the year, there is nothing for the opening stock. So your purchases you found from here 1,170, and your closing stock valued as 600, but that was not recorded. The inventory withdrawn and the inventory losses. So your closing stock, the correct amount should be 510, and that inventory damages you should deduct when you're finding the cost of sales, and that is an expense for you as well. And the stock drawing you should minus from the cost of sales and debit to the current account, right? And cash flow paid for the operating expenses amounting 187, and that include the last year's payables 17, so that you should exclude. And additionally, 25 was recognized as payable, you should add. And additionally, Virendra personally paid 40,000. That also you should add it to find out the operating expense for the year. And the Virendra's payment for the operating expenses, you should credit to the current account, right? And since Nimal was directly involved in the partnership operations, a monthly salary, they decided to pay 12,000 starting from 1st of July. So which means you have to find out, you have to appropriate only for 9 months. Huh? At the startup, they didn't decided yet for the anything for the partner salaries, but on 1st of July, they decided to pay 12,000 starting from 1st of July. So you have to appropriate salaries for 9 months, and that you should credit to the current account. And they already paid for first 6 months, and that salary is reimbursed, you should credit to the current account. And as in opening date and closing date, the property, plant and equipment expect land is 2,150 and 2,450. You have to mention, record that in property, plant and equipment account. And these are given as the carried amount. And here you sold 280. So 280 here disposal you should credit, and you are selling 280 carrying amount worth motor vehicle for 325. So from that you are getting a profit. So that motor vehicle selling profit you should add it to the other income. And then you are again purchasing 690 new office equipment. So balancing these, you can find out the property, plant and equipment depreciation here, and the property, plant and equipment depreciation you should consider as an expense. So after recording all those cases, you can find out the net profit. From that net profit, you have to exclude the salaries appropriated to the NIMAL, and the remaining amount you have to distribute as per 2:1 profit ratio for Sarath, Virendra and Nimal, and those profit shares you should credit to the current account. And here at the end, before that, the recruitment, so the capital account opening balance is 4,000, 4,000. And here the recruitment, Nimal is bringing 1,750 for capital and 400 cash the goodwill. So altogether, he is bringing to the business to 150, and that should credit it to the Nimal. And the goodwill portion he bring into the business is 400, and that should debit to the Nimal's capital account. And new ratio credit at the goodwill adjustment. So 2 to 1. So 1 out of 5 is 400. So which means your total goodwill at the beginning is 2000. And that should credit to the S and V, which means Sarath and Virendra, equally at the old ratio, based on the old ratio, right? And that's it for the admission. And then the retirement. So at the retirement, Sarath is retiring from the partnership. So first of all, Sarath's current account balance you should transfer to the capital account. And at the end of the goodwill estimated at the end is 1,500, and it should credit based on all ratios. So at that point, old ratio is 2 to 1, and the new ratio is 2 V and N. And then the 500 was decided to allocate a land to a Saras, and the remaining amount you should transfer to the loan account. දැන් මේක කියලා දෙද්දි ලේසි වගේ හිතුණානේ මේක පොඩ්ඩක් මහතයි හදන්න කියලා. So that's why I gave here 30 marks. Okay. And next one, petroleum profit analysis. So here, Nalanda College 2025 LL Commerce Group is organizing a friendly gathering after the exam. It's a very common thing. The chairman of the Commerce Society, Sanitu is my Mali, and he was the best result in my 2024 LL. He's provided the following estimated information for the event. The event invites 24 teachers from the school commerce department, but from those, 15 have confirmed the attendance. Right? So first of all, you have to find out the fixed deposit and the current stage. So here the invited teachers dinner, 2,400, it should calculate only for 15 teachers, and for the gifts as well. Because they invited for 24 teachers, but 15 is the only amount that they confirmed, right? And the whole rental sound system, decoration, LED screen, all those cases falls under fixed cost. Then your total fixed cost is 180,000. And then the second thing, they're asking the minimum number of tickets that must be sold to cover the cost. So they're asking the break-even point over there. But before the finding the break-even point, first of all, you have to find out the variable cost per student. So the variable cost per student is dinner and souvenir, so 3,000. Ticket price minus variable cost, you can find out the unique contribution. And if you know the fees cost and the unique contribution, then you can find out the break-even point easily. And then the surplus revenue, if 100 students participate, to find out that total contribution minus fees cost. So if 100 students are going to participate, 3,000 into 100, your total contribution is 300,000. And from that, you have to minus the fees cost, then you can find out the surplus. And fourth one, they are asking minimum number of students required to raise a surplus of 90,000. So the expected profit is given here. So expected profit plus fees cost. This is the total amount that you should cover from your contribution. And to that, you should participate minimally 70 students. And fifth one, the minimum number of tickets that must be sold if all invited teachers are going to attend. So at that point, you have to first calculate the new fees cost. The existing fees cost is 180,000, and to that, you have to add the other 9 teachers' food and gift cost. And new break-even point is 219,600. That divided by 3,000, then 73.2. So which means minimally 74 students must be participate to for that cost. At 6 it says minimum number of figures that must be sold to cover if all rental is subsidized by the school's old student association. So in your new fixed cost after excluding that LED screen, sorry, for rental, the new fixed cost that you should cover is only 132,000, and that you should divide it by 3,000. Then minimally 44 students should participate to cover the cost. Okay. The sixth question is from cash flow, and this is a bit hard actually. From this information, you have to prepare the operating cash flow based on direct and indirect method. And here, let's discuss for the direct method first. And additional information number one is given about the proper plant and equipment. So by reading out that, you can think that nothing to do with what? With direct operating cash flow, but from that proper plant and equipment count, you have to find out depreciation. And depreciation is already added to the admin expenses. And to exclude that depreciation from admin expenses, you have to do the proper plant and equipment adjustment here, right? Opening and closing balances, and the new computer purchases and the disposals, then you can find out the depreciation here, right? And that depreciation you should debit to the admin expenses, and after recording opening and closing balances and the income statement amount, then you can find out the cash payment for admin expenses, and that goes in cash outflow as in operating activities. Second one, based on lease assessed. So in the trial balance, so from that you have to find out the motor vehicle depreciation, the difference between the carrying amount of the motor vehicle, which means the right of use of this property, and that is the motor vehicle depreciation, and that already included in distribution expenses. So when you're adjusting, sorry, in distribution expenses, that leased motor vehicle depreciation you should debit, and the prepayment at the opening and closing you should adjust here income statement amount, and the impairment loss difference. So in this case, it is a over provision, and that over provision you should credit here, and then bad debts and discount allowed you should debit to the distribution expenses. Then you can find out the distribution expense payment in cash, right? And other income includes 45,000 discount received, and that is important when you're finding out the creditor payments. So in creditor control account, those discount may received, you should write down here, right? And the sales commission income also you should add it as cash inflow under operating activities, and nothing to do with rental income in direct method. And yes, again, it's given about the motor vehicle distribution expenses, and from that, bad debts and discount allowed, you should credit to the debtors control account, because from the debtor control account, you should find out the debtor payments, sorry, debtor receipts, right? And then from those totals, you have to find out the cash sales and cash purchases. And here you can find out the data receipts and creditor payments. And those cases you should record in operating activities in direct method. And financial expenses include 40,000, and the rest is loan interest. So tax expense and interest, by adjusting those, you can find out the tax and interest that paid in cash, and tax paid and interest paid comes in direct and indirect both formats, right? And for the indirect method, you have to get the profit before tax as the base, and from that you have to minus property, plant, and equipment depreciation. Sorry, you have to add, because those are non-cash expenses, but it's already deducted from the profit. Then you should add, and the lease property depreciation also you should add, and rental income. the rental income for the year, you should minus from the operating, profit before tax at the adjustments. And then, yes. And uh, the bank charges, yes, the bank charges you should consider as cash outflow when you're preparing operating cash flow in direct method as well. Huh? And here, the loan interest for the year, you should add it at the adjustments, and then again, the cash paid amount you should minus at the bottom of the operating cash flow when you're finding out the indirect method. And then the difference between uh, working capital, which mean inventory, trade receivables, distribution, prepayment, trade payables, and admin payables, right? And the impairment loss, that over provision, you should deduct from the adjustments. Okay, so that's how you have to prepare the cash flow based on direct and indirect. And the 6B, they given the journal entries and then they are asking the adjusted profit. So for the entries, I didn't mention here the narrations, but you should mention. No? So the first thing is total of the discount column in cash payment journal. So which means the discount received, they debited to the discount allowed. So to correct that, discount allowed should credit and discount received you should credit. So altogether total you should debit to the suspense account. And the last quarter's petty cash expenses they didn't mention, but petty cash control account they recorded correctly. So the double entry petty cash expense debit and suspense account credit. And third one, the loan interest you debited the total loan installment to the bank, uh, but you didn't consider the interest over there, right? So that interest you can't debit as like the bank loan payment. It should consider as a loan interest. That is an expense for you. And bank loan you should credit to reverse that entry. And advertising prepayment, what they did, they they debited that to the advertising account, uh, double. So advertising expense you should credit, and the advertising prepayment is an asset you should debit, and the suspense should debit. And the sales advance you credited to the sales double. So sales account should debit double. Sales advance is a liability, and the suspense account both you should credit. So from those discount allowed and discount received credit, it should add it to the profit. And petty cash expense minus from profit, loan interest minus from profit. Advertising written off, which means reverse, you should add it to the profit. And sales reverse, you should deduct it when you're finding out the profit. Then you can find out the adjusted profit. Okay, kids, we are coming to the last slide, and it's given about the debtors control account and subsidiary ledgers. So here they are asking to prepare the adjusted debtor control account. So the balance is given in the debtors control account as 745,000. And what they did, the correct sales is 2,475. But that no, the correct sales is 2,745, but they recorded that as 2,475. So the sales was understated, and that amount you should you should debit to the debtors control account. And the cash receipts fully omitted, and that should credit to the debtors control account. And the total of discount column in March cash purchase, cash receipt journal 170, debtors they recorded correctly, so nothing to recorrect here. Returns 110 and 130, they didn't record in debtors control account, so return inwards you should credit, and bad debts fully omitted, and that also you should credit here, then you can find out the debtors correct balance. And here, the debtors control account and sociology both are prepared by the business itself. So if you prepared both correctly, the closing balance should be equal, right? So here the debtors control account adjusted balance is also the correct balance of the debtors ledger balance. So based on that, then you can find out the debtors ledger balance before corrections. So which means from those errors, you have to do the errors as it is that affected to the debtors subledger, right? Mm, the unstated sales, so that amount you should minus. They didn't record cash receipt, discount allowed, and bad debts in debtors ledger. So those things you should add up to here. So you have to do the error as it is. Then you can find out debtors incorrect. So which means the balance before corrections in debtors ledger. So that's why in discussing here the standard paper that I made to make one freshly. So if you want the paper, send me a message. And if you can purchase the other model papers as well. But this is very special. This paper was made based on 2024 past papers, right? So I'm done here. Yes. If you learn or if you get anything from my video, paper, please do a comment. That is very worthy for me. And please do share with your friends. So we will meet from another question or paper discussion or something. So until that, goodbye. Work hard for your errors. There you go.